Do you ever feel like you're doing everything right, but it's still not enough? You work harder than ever. You make more money than you used to. You try to budget, you try to save, and yet, somehow, money feels tighter than it ever has before. Your rent just went up again. A trip to the grocery store feels like a major expense. The idea of buying a home or paying for education feels like a distant dream. And the debt, it just never seems to go away. If this sounds familiar, you're not alone. Millions of Americans are quietly asking themselves the same question. If the economy is growing, and I'm working so hard, why does my life feel so much harder? This isn't a story about bad decisions or avocado toast. This is a story about how the entire system around us slowly, almost silently, changed. To understand why your wallet feels so squeezed today, we need to take a step back. We need to look at how the very nature of money in America evolved. For most of our history, money was expensive. Think about that for a second. To borrow it, you had to pay a high price. Interest rates were higher, which meant that taking on debt was a serious decision. There was friction. It wasn't something you did casually. This reality shaped how people lived, how they bought homes, and how they planned for the future. But then, things began to shift. Over the last several decades, in response to economic shocks and recessions, a new strategy took hold. To get the economy moving again, central banks started lowering interest rates. The goal was to make it cheaper for businesses to borrow and invest, and for people to spend. At first, these were temporary measures, designed to provide a short-term boost. But gradually, what was once temporary became the new normal. We entered a period that economists now call the age of easy money. Money became cheap, credit became abundant, and debt, which was once a heavy burden, transformed into a central feature of everyday life. The intention was simple and, on the surface, positive. Keep the economy growing, keep people spending, and keep investments flowing. But every system design, no matter how well-intentioned, has consequences. And we are living with those consequences right now. When you make it cheaper to borrow money, prices for big-ticket items inevitably respond. And there is no better example of this than the housing market. For generations, a home was primarily a place to live, a part of the community. But in the age of easy money, it also became a financial asset, a vehicle for investment. Here's how it happened. Lower interest rates meant that a potential homebuyer could qualify for a much larger loan for the same monthly payment. A $300,000 mortgage at 6% interest is very different from the same mortgage at 3%. Suddenly, buyers had more borrowing power. They could bid higher for the same house. This didn't cause prices to skyrocket overnight. It was a slow, creeping process, year after year. As more and more people could borrow more and more money, sellers could ask for higher and higher prices. The crucial part of this story is that wages did not keep up. Home prices started to detach from what people earned and began to reflect what people could borrow. The market wasn't tracking income anymore. It was tracking access to credit. This is the fundamental reason so many people feel locked out of the housing market today. It's not because they failed to save or didn't work hard enough. It's because the system began to reward financial leverage far more than it rewarded labor. The game changed, and the goalposts moved. This same pattern repeated itself in another critical area: higher education. For a long time, college was expensive, but it was within reach for many families through savings and part-time work. Then, the federal government stepped in to make student loans widely and easily available. The goal was noble, to make sure anyone who wanted to go to college could, but the result was unintended. As students gained access to larger and larger loans, what do you think happened to tuition? It went up, and up, and up, and up. Colleges and universities adjusted their prices not to what a family could reasonably afford out of pocket, but to the maximum amount of financial aid a student could possibly get. Debt was reframed. It wasn't a burden. It was an investment in your future. It became normal, expected, and for many, completely unavoidable. An entire generation was systematically encouraged to sign on the dotted line, entering their adult lives already thousands, or even hundreds of thousands of dollars behind. This wasn't because of poor personal choices. It was because the structure of the system made debt the default path to opportunity. And this logic of easy credit didn't stop at houses and degrees. It seeped into every corner of our daily lives. Credit cards offered points and cash back, encouraging us to spend money we didn't have. Buy now pay later services popped up everywhere, breaking down purchases into easy monthly installments, and our world became dominated by subscriptions. From entertainment and software to meal kits and even cars, modern life slowly shifted from a model of ownership to a model of perpetual payments. Everything became manageable month to month. That new phone is just $40 a month. That streaming bundle is only $25 a month. On paper, it all seems affordable. But the reality is, nothing ever feels truly paid off. This system is brilliantly designed to keep consumption moving, but it's also designed to keep you in a state of constant financial pressure. When your life is built around a dozen different payments leaving your account every single month, your sense of freedom quietly shrinks. You're always just one unexpected expense away from a crisis. Over time, living in this system started to change how people see themselves. The constant stress, the feeling of running in place, began to feel personal. If you're struggling to pay your bills, it must be your fault. If you can't afford a house, you must not have saved enough. The struggles started to feel like a personal failure. But here, as the most important thing to understand, when millions and millions of people are all experiencing the exact same pressure, the exact same struggles, it is no longer an individual problem. It is a structural one. The feeling of being squeezed isn't a reflection of your character. It's a reflection of the environment you're operating in. Understanding this history doesn't magically pay off your loans or lower your rent. I wish it did. But it does something else. Something incredibly powerful. It changes the story you tell yourself. The reason money feels so much harder today is not because people got lazy or irresponsible. It's because the system we live in became infinitely more complex. It was designed over decades, built layer by layer, and optimized for perpetual growth and consumption, not for individual peace of mind. Once you see the structure, the logic of easy money, the detachment of prices from wages, and the shift from ownership to payments, your everyday struggles start to make a lot more sense. It's not you. It's the design, and realizing that letting go of the self-blame is the first real step. Clarity, not blame, is the real beginning of finding your way forward. Thanks for watching. If this resonated with you, consider subscribing for more videos that break down the systems shaping our world.